Hi everyone, Chris Ansell at UWorld with you again, and this time we're looking at static yield curve strategies. It's just one learning outcome statement for you to worry about. To be able to formulate a portfolio positioning strategy given forward interest rates and an interest rate view that coincides with the market view. Okay, so let's look at our 5 different strategies. We're assuming a normal upward sloping yield curve. So our first strategy is simply buy and hold. Our income is the coupon income that we receive from holding the bond. Our objective, ensure that we have duration beyond the target duration of any liability. Then there's rolling down the yield curve. We get our coupon income, but also as the bond becomes younger and younger, its effective duration becomes lower. So the effective yield to maturity comes down and the value of the bond goes up. It looks a little bit like this. So as the bond ages, its time to maturity reduces, the required yield to maturity comes down, and therefore the market price of the bond goes up. So even if we're not holding it to maturity, we are receiving a price increase each year in addition to our coupon income. If we now move on to our repo carry trade, here we are long a high yielding instrument and we finance that via a lower yielding instrument. So our objective is to earn a repo carry return. So our income is our coupon income plus or minus our roll down return as before, but this time reduced by the cost of financing the bond. Then we move on to our long futures. Here we rely solely on price appreciation rather than the coupon. We're synthetically increasing our duration through minimum upfront cost. So we're getting exposure on margin. Then finally, our